quick second. Um, little midweek check-in or end of the week check-in. How's it going, Teresa?
It's going good.
Excellent. Anything
Yeah.
fun going on?
No, just work.
Same, same. I get to talk to Melissa and Manon more often, so I wanted to make sure that I check in and say hello at least.
Oh yeah, of
Instead of
course.
just, you know, throwing all of this, I feel like I'm just vomiting all of this information at you. So
Well, it's a good refresher for me, so I
excellent. Okay. Well,
need this
Manon,
probably twice a year.
oh yeah, yeah. Okay, well, I think we're ready to go ahead and start recording, Manon. We're going to start today with tax sheltered annuities for 403B plans. Yesterday was more about the overall settings for 401k, and then we touched a little bit about 403B. So with 403B, those are more for your public schools, tax exempt charitable organizations, religious and educational organizations are able to purchase also tax sheltered annuities for their employees under the requirements of IRC 403B, only if the annuity contract may not be purchased through a qualified annuity plan 403A. The employee rights must be non-forfeitable unless the employee fails to pay their premiums. The plan must meet certain non-discrimination requirements generally applicable to deferred compensation or 401k plans, unless they're a church. They must offer all employees the chance to defer at least $200 in compensation annually if one employee is given that opportunity. So all or nothing. The elective deferral limits must be met if the plan provides for a salary reduction agreement. Your contribution limits. So we went over the general defined contribution limits or elective deferral limits yesterday and the catch-up limits yesterday. Another addition when it comes to your 403B is the 15-year of service catch-up. Employees with at least 15 years of service with the employer have an additional catch-up eligibility. This additional catch-up is limited to the least of the following up to the maximum exclusion allowance. So the calculation is $3,000 in additional contributions in any year. Total catch-up contributions of $15,000 or 5,000 times the number of years of service. So 5 times that 3,000, less your total elective deferral payments from previous years. Kind of convoluted, but it does give them that additional catch-up limit that they otherwise wouldn't be able to get. The tax treatment of 403B plans, as long as the annuity plan meets the qualifications of a 403B employer contribution and employee elective deferrals to the plan to purchase annuity contracts are not wages subject to federal income tax up to the contribution limits. Only the employee contribution is subject to Social Security, Medicare, and FUTA. Distributions from the plan are taxable when the annuity payments are made, but other employer contributions are not. You'll still want to double check your state and local laws to double check and make sure that any of those may or may not apply. The reporting for 403B plans, elective deferrals, and employer contributions are subject to the same reporting on W-2, 941, 940, as we discussed yesterday with the 401k plans, with the exception that elective deferral plus catch-up is required to be on box 12 of the W-2 and would also need to have the code E in box 13 for the retirement plan must be marked. So it's just in a different box with a code, or same box 12, but a new code for that W-2 based on the 403B. For a Roth 403B, You may permit employees who make elective contributions to designate some or all of their contributions as a Roth IRA. The combination of Roth 403, elective 403, and catch-up cannot exceed the 19,500 or 26,000 with the catch-up limit in 2020. Pardon me. Deferred comp for public sector and tax exempt entities. Your state and local government employers, tax exempt organizations other than churches can set up deferred compensation retirement plans for their employees under the IRC 457B. 457 is treated in many ways as a non-qualified deferred compensation plan, which we'll discuss more later. 457B requirements include eligibility for individuals performing service, is for individuals performing service, such as employees, including independent contractors. With regard to non-discrimination testing, unlike 401k plans, 457B plans can be provided in a discriminatory manner, which seems so difficult to comprehend at times, but it's allowed to have that discrimination for your highly compensated employees. There's additional catch-up contribution caveat for 457 that allows individuals who are participants to they are allowed to contribute 2 times their annual deferred compensation limit for 3 years prior to their normal retirement age. So the example of 2020 having the 19,500 as their limit, they could put in 2 times that, or 39,000 for this year. The reporting requirements for a 457B differ in that because employee elective deferrals and employer non-elective contributions to the plan are not wages subject to federal income tax, they are not included in box 1 of the employee W-2. The employee elective deferral and employer non-elective contributions must both be included in box 3 as Social Security, box 5 as Medicare. That's in sharp contrast to the 401k and 403b, where only the elective deferral is included in those boxes. The Social Security and Medicare tax withheld would also be shown in boxes 4 and 6, respectively. Elective deferral, catch-up, and non-elective deferral must both be included in box 12, code G. Reporting of Roth deferrals would go in box 12, code EE. So those codes are really important to know the difference in how they apply to each style of compensation plan. We have our first pop quiz next. Oh, no, we don't. Sorry, I'm a screen ahead of myself. Here we go. Your first pop quiz, you're going to calculate an employee's net pay based on the following information. This individual is paid bi-weekly. Their annual salary is $120,000. This is an exempt employee. Hours worked in week 1, 45. Week 2 is 50. 2020 W-4 information, head of household. Step 3, 6,000. And these are all important factors to know how you actually fill out this worksheet that we're going to go to in a second. As you complete the CPP or FCP exam, you will have the opportunity to fill out those worksheets. Their year-to-date wages when this contribution or this calculation is taking place, they had been at 87.5. Year-to-date 401k contribution, 19,000. 401k contribution is normally 20% of wages. Employee's age is 46, and we're going to use the percentage method. This is the actual answer. Here's your worksheet. So when we fill this out, before we get to step 1, we actually need to stop and take a second to calculate what that biweekly pay is. So if they're biweekly, there's 26 pay periods in a year. It said their annual salary was $120,000. So 120,000 divided by 26 is 46.15. Another item before we could even get really started, the other item was knowing that the person had already hit 19,000 for their annual contribution limit. So that 20% didn't even make a factor. They could only put in another $500 to hit their annual contribution because, as it also said, this individual is only 46. And I should also explain where it indicated the person had 46 or 45 hours in week 1 and 50 in week 2, a non-factor because it's an exempt employee. So we're only going to go by that annual salary. We've gone through and filled out this worksheet to know exactly where all of these items go. So first step is taking and finding that gross wage that we're going to calculate federal tax on. So we take 46.1538 minus that 500 that they are contributing to their 401k, and that's 4,115.38. We're going to enter in the number of pay periods, which is 26. We did not have listed in the instructions any information for step 4 on the W4, so we're going to leave 0. And divide line 1C by 1B, 0 is 0. Add lines 1A and 1D, so 411538 plus 0 is still 4115. You get the math. When we get down a little farther in step 2, in 2A, you're going to take the information off from the table and find the appropriate row for that pay group, or the 4,615.38, so we know how to tax this properly. So it would be 4,006 to 6,998. Your tax level is 4,006, or your first item for 2A. 2B wants column C of that row, 50612. Enter the percentage amount, that's 24%. So you're just reading this information directly off from that table. You're going to do the math instructed. We come up with 109.38. And here is your tentative withholding amount, $532.37. That's our tentative withholding amount. Then we go in, we find out that this individual also had $6,000 in dependents. We're going to divide that by the number of pay periods that we have. And we come up with 230.77. And subtract line 3B from 2F. So 532 minus your 230 is 301.60. Our withholding amount for this employee is going to be the 301.60. You're going to calculate your Medicare and Social Security on that full 4,615.38. Do the math. With rounding, our total came up to a pay net pay of $3,460.70. Just a moment here, it went the wrong direction. $3,460.70. When calculating an employee's net pay, determine first if the employee is exempt or non-exempt to calculate any overtime. Be sure to reduce the gross wages by the 401k deferral before calculating income tax, but do not reduce the wages by the 401k when calculating Social Security and Medicare. I'm certain you will have this more than once when it comes to taking the exam. Your non-discrimination testing in a 401k, completely new topic. So we've covered your deferred compensation or your actual employee elected deferrals for 401k, 403b, and 457 slightly. Now we're going to go into the non-discrimination testing for 401k. In addition to meeting the general requirements of a qualified plan, a qualified 401k plan must also satisfy one of two tests showing that it does not discriminate in favor of highly compensated employees in terms of the percentage of compensation actually deferred by participants. The definition of a highly compensated employee, or HCE, is any employee who's 5% owner of the employer's stock or capital at any time during the preceding year. They've also received an annual compensation of greater than $130,000 in 2020 during the preceding year. And to me, this little side note, that's can be a confusing thing because they also, everything with highly compensated employees, they're looking sometimes for current year information, and most of the time it's being based on their previous year. Current year limits, but what they received in the prior year or preceding year. Tests require that the ADP, or actual deferral percentage, of highly compensated employees for the current plan year to not exceed the ADP of eligible non-highly compensated employees for the preceding year by more than a certain amount. Tests determine each eligible employee's ADP, and the ADPs for each group are also then averaged. When this is done, the average ADP for eligible highly compensated employees may not be greater than 1.25 times the average ADP for a non-HCE, or the lesser of 2 times the average ADP for eligible non-highly compensated employees, or 2% more than the average ADP for an eligible non-highly compensated employee. Super confusing, super confusing. So if you're feeling baffled, that's fine, you should be. It is interesting once you have the opportunity. I hope you all have the opportunity to experience it at some time, to be able to review how those reports look when your retirement plan does those, will go through and do those reports for you. So you can see the overall percentage of how much your highly compensated employees are contributing versus the rest of your group. And that's all they want to make sure is, are those people getting preferential treatment more so than your regular Joe employee? If they're able to contribute more, you can either, so when we'll go into how those plans fail and what you can do to rectify the situation in a little bit, but the easiest thing to do is you either refund that money out of the highly compensated employees plan, or you end up increasing the amount of the regular employees deferral, not their deferral, but the employer contribution. They can be beefed up so that it doesn't penalize the highly compensated employee, and everything ends up being a complete match to keep your plan in compliance. I hope that helps clear it up a little bit. So here's your example. Mariana works for ABC Design Company and in 2020 receives $300,000 in compensation. She is less than 50 years old in 2020. Marina wants to defer 19.5 in ABC's 401k plan and elects to defer 6.84% of her compensation. 19.5 divided by blah, blah, blah. At the end of 2020, ABC tests the 401k plan for non-discrimination testing compliance. Marina is the only HCE, and the non-HCE employees have electively deferred 2.5% into the plan. So therefore, the plan fails to meet either ADP test. For this 401k plan to remain in compliance, Marina's elective deferral must be reduced by 4.5% of $285,000 or $1,285. The $6,685 or $75 excess deferral and any earnings that she made, any interest that she has earned on that $6,675 must be returned to Marina for the plan to remain in compliance. That causes those highly compensated employees to quite often have to refile their taxes if they've already done them, all those good things. If an highly compensated employee or HCE defers income to more than one 401k plan, then their elective deferrals are totaled for purposes of applying the special ADP non-discrimination test to each plan. All employer plans are treated as one when determining the employee's ADP. Employers have alternate methods for meeting the non-discrimination requirements other than ADP tests, which are based on matching or non-elective contributions made by the employers. A little side caveat here, your ADP and ACP testing is a definition that I was tested on when doing the CPP. So you'll want to make sure that you understand what those tests do and what happens or how to prevent plan failure, what you can do to rectify it, such as refunding those highly compensated employees. An employer meets the matching requirement, the matching contribution requirement if, for non-highly compensated, it matches 100% of the employee's elective deferral up to 3% of the employee's compensation and 50% of the employee's compensation. That's called basic matching. You can also use the enhanced matching formula. With this method, the employer provides matching on behalf of each non-highly compensated under a formula that at any rate of elective contribution, it provides a total amount of matching contribution at least equal to the amount of matching that would have been provided under the basic method. With either of these methods, the employer must not match highly compensated elective deferrals at a higher percentage than it does for non-HCEs. Failure of an ADP test, all participants will be taxed on their elective deferrals unless the plan takes corrective action. Again, that's where I was pointing out, it's very important that you know how to rectify the situation if your plan fails. So you would either have to have all employees indicate that those are wages now and pay tax on their 401k elections, or you can refund those contributions to the highly compensated employees, or increase additional contributions to the non-highly compensated employees, which will increase the overall ADP of the non-highly compensated employees. Super confusing, I know.
But those examples are really helpful when talking about these.
Well, and ask any questions that you might have. I've seen several plans where they did fail, so I've made those corrective actions in a variety of ways. And it doesn't really matter how you correct it, as long as you correct it. And obviously, the least popular option would be to have everyone pay tax on their elective deferrals. Nobody wants to do that. If they've elected to participate in a 401k, they're assuming that it was pre-tax, they want to leave it pre-tax. So pop quiz. When performing discrimination testing for a 401k plan, which of the following employees is a highly compensated employee? You guessed it, an employee with compensation of $135,000 in the prior year. I feel like that's probably one of the most confusing things when it comes to highly compensated employees, and even the non-discrimination testing is you're using current year information, but you're kind of using last year's information as well. And that's where you need to make sure that, all right, what did people make last year? What did they contribute this year? Am I right? Am I wrong? It gets confusing. So non-qualified plans. Any employer plan designed to provide employees with compensation that will be deferred to a later date, of course, retirement, and that does not meet requirements of the IRC 401, so your 401k plans, is considered a non-qualified deferred compensation plan. Employers often use such plans to compensate certain high-level or C-suite executives because they're not restricted by those non-discrimination requirements that apply to qualified plans or the contribution and benefit limitations. A non-qualified plan may also be base benefits on compensation not included in calculations for other employees, such as bonuses. Deferrals to non-qualified plans include your simple employee pre-tax salary reductions, employer contributions, and earnings credited to the employee's account. Before 2005, the rules governing the tax treatment of the constructive payment. Before 2005, the rules governing the tax treatment of employer contributions to non-qualified deferred compensation plans were based on the doctrine of constructive payment. Generally, this means wages were taxable when they were set aside for and were not accessible to the employee without significant restrictions. Plans with no changes or no plan document changes, keyword is plan document, with no changes since December of 2004 must follow these rules. So while they are non-qualified, they still have to meet certain criteria. Additionally, non-qualified deferred compensation plans can either be funded or non-funded. An unfunded plan just simply means that there are nothing more than employers' promise to make payments at some future time. The employer's contributions to the plan generally are not included in the employee's income and are not subject to federal income tax withholding until those payments are made or constructively received. If a plan is funded and the employer makes contributions, those contributions and earnings based on them are wages subject to federal income tax withholding when the employee's interest is vested or no longer subject to risk or forfeiture. To avoid inclusion in income, a plan must not allow distributions from non-qualified deferred compensation plan any earlier than separation from service, 6 months after separation in the case of a key employee of a publicly traded corporation, the date of disability or death, a specified time or fixed schedule contained in the plan when the deferral election was made, change in control of a corporation, or the occurrence of an unforeseen emergency, severe financial hardship. Pretty much every plan has the option for unforeseen emergency, severe financial hardship withdrawal. Your deferral election requirements. The plan must also provide that elections to defer income earned in a year must be made before the end of the preceding taxable year. If an employee's performance-based compensation will be based on work performance over a 12 months or more time span, the deferral election must be made no later than 6 months before the end of that service period. Again, look back, look forward. The time and form of distributions must be specified at the time of deferral, either by the plan itself or by an election of the employee. Amounts included in income when contributions to a non-qualified plan are not subject to the distribution restrictions we just went over, the contributions are included in the employee's income. You can see on the bullet points on this slide the guidance that the IRS has provided on how you determine what you include in the employee's income. Definitely things to keep watch of. These are the 3 steps in calculating the amounts, the amount deferred that would be included in income. You have determine the total amount deferred under the plan for the employee's taxable year and all preceding years. Calculate the portion of the total amount deferred for the taxable year that is either subject to substantial risk or that has been included in income in previous years. Okay, so think through that piece. If it was included in income in previous years, you're not going to tax them again on it. So you wouldn't include it in their income again. Subtract the amount determined in step 2 from the amount determined in step 1, and the excess is the amount in includable income and subject to additional income tax. In general, under the proposed regulations, the amount deferred under a plan for a taxable year and all preceding taxable years is referred to as the total amount deferred for a taxable year and is determined at the last day of the taxable year. For calendar year taxpayers, as most of us are, the relevant calculation date would be December 31st. This procedure avoids the administrative burden of tracking amounts deferred under a plan on a daily basis. Adjustments would not be made to reflect earnings or losses other than fluctuations in the amount payable under the pay as they occur, but rather applied only on a net basis on the last day of the taxable year. Treatment of payments. To reasonably reflect the effect of payments made during a taxable year, the proposed regulations provide that the sum of all payments of the amounts deferred under a plan during the taxable year would be added to the amounts deferred outstanding as of the last day of the taxable year to calculate the total amount deferred for such taxable year. I feel like I'm talking in circles because that's sure what it sounds like. Welcome to 401k and retirement plans. Treatment of losses because of the because the total amount deferred is determined on the last day of the taxable year, losses that occur during a taxable year generally would be netted with any gains that occur during that same year. Treatment of rights deemed earnings on amounts deferred. Proposed regulations provide that earnings credited with respect to deferred compensation during a taxable year or were credited in previous taxable years, and earnings with respect to deferred compensation paid during the year must be included, determining the total amount deferred for said year. Super confusing, and you have to remember that this particular piece is on a non-qualified plan. So there's typically a lot higher dollar amounts being pushed in and out. They gain more. The regulations for pulling the money out are different. The way you tax these items on their income is way different than in a standard 401k plan. And yes, man, and I can see the look on your face, and it is that confusing. So assume an employee begins a taxable year with a $10,000 balance in their account balance. During the year, the employee has an additional deferral to the plan of $5,000 and incurs net deemed investment losses of $2,000. No payments are made pursuant to the plan during the year. The employee has no vested legally binding right to further deferrals to the plan, and there are no other changes to the account balance. The total amount deferred for the taxable year would equal $13,000. The account balance of $10,000 plus $5,000 less $2,000 for those losses as of the last day of the taxable year. When you see it in a number form, it might actually help a little bit, but it is super confusing. I've worked in places that had a 401k plan plus a 457 so that they protected those highly compensated employees and let them throw any excess into 457, where the 401k was everything had to match and the plan had to be in compliance at all times.
Hey, Rebecca.
Yeah.
Can you just briefly, and hopefully you know this right off the top of your head, but you've mentioned highly compensated individuals and key employees. Do you know the specifications of those two categories?
We'll go right back to it. So a highly compensated employee for 2020 has to have earnings of greater than 130,000. Let me see. Your key employees, which are not listed on here, key employees are typically those that have hiring and firing rights, have a certain amount of percentage of ownership in a company. So they have those. They don't necessarily have to have the compensation piece. They typically do. It's kind of most that are HCEs are also key employees, but they are two very different things.
Thank you. And I'm sorry, I did put you on the spot. So I did actually look up what a key employee included, and the list is corporate officers whose annual compensation is greater than 185,000 for 2020, is a 5% owner, or a 1% owner whose annual earnings are greater than 150,000.
Is that key for a retirement plan?
Yes.
Okay. There are different rules for different key employees, for different facets of employment that would consider you a key employee. So that's why I was just curious.
Okay, thank you.
I know, it's crazy. It's crazy. Okay, let's get back to, we're going to wrap up today's session on slide number 39. Here's just a couple other of important definitions that you need to know for non-qualified plans. So the treatment of payments, the sum of all payments deferred under a plan year during a taxable plan year would be added to the amounts deferred outstanding as of the last day of the taxable year. Treatment of deemed losses, because the total amount deferred is determined on the last day of the taxable year. Losses that occur during a taxable year generally would be netted with any gains that occur during that same year. So assume an employee begins a taxable year. Oh my goodness, they gave us that same exact example. $10,000 balance.
I think you're on, I think you need to move forward one slide.
Yep. Maybe. Okay. Total amounts deferred on a taxable year. The total amount deferred under a plan for a taxable year would refer to the total amount deferred on the last day of the taxable year. If a plan is amended during a service provider's taxable year to add a provision that fails to meet the requirements of 409A, the total amount deferred as of the last day of the taxable year would be included in income. This would include all payments under the plan during the taxable year, including payments made before the amendment. So that's going to be important to know how to manage that payment. Treatment of short-term deferrals. For purposes of calculating the total amount deferred under a taxable year, the right to a payment that as of the last day of the taxable year may or may not be short-term deferral is not included in the amount deferred. Assume that as of December 31st, an employee whose taxable year is the calendar year is entitled to an annual bonus that is scheduled to be paid on March 15th, excuse me. And the bonus would qualify as a short-term deferral if it was paid before the end of the applicable 2.5-month period ending March 15th. The bonus would not be included in the amount deferred for 2020. This would be true regardless of whether the bonus is paid on or before March 15th. However, the bonus would be includable in the total amount deferred for 2021 if it's not paid on or before March 15th. Just to point out a couple of items that you will definitely need for a test, I'll just remind you, you'll need to know the definitions of an ADP test on your plan and what items you need to do to bring that plan back into compliance if it should fail an ADP test. You'll also need to practice calculating the net pay for pre-tax and post-tax deferral, so your Roth. Tomorrow we'll begin our last session on retirement plans, and we'll be calculating the total amount deferred on non-qualified plans. That's what we'll start out with tomorrow.
Thank you, Rebecca.
You're so welcome.
Thank you.
Retirement plans can be confusing, but once you actually see the numbers in motion, you'll get it. I promise.
I appreciate your confidence in us.
I have full confidence.
All right. See y'all tomorrow.
Bye.
Okay, bye.